Good day, ladies and gentlemen. Chapter 7 in Cost and Management Accounting is the focus for today. Chapter 7, this 7.1 question that I'll be recording is very basic, but it goes to the basics and the foundation of this chapter. However, in the exams or assessments, there will normally be more information provided, and I also do have already other recordings on this chapter that have more information than this one, but covering the same content, to be honest. Now, I will not start with the requirements because the information that is provided is very basic. So I'll just read it through, then go to the requirements, analyze them, then after and answer them. Whom Palm Ltd manufactures and sells a single product, and the information regarding this single product is made available to us below. We have the selling price, which is per unit of 45 rand, meaning every unit of this single product is sold at 45 rand for the given period that we have in our disposal. Variable cost per unit are 17 rand per unit. Take note. I want to highlight the per unit part also. We have our fixed cost in total, that is 50,000 rands. Take note the fact that it is in total, not per unit. Our total sales value are 85,500 units. So now these are the number of units that the sales value that was received. Obviously, we must have sold a certain number of units, which is 85,500 divided by 45 rand. This gives us 1,900. It means 1,900 are the number of units that were sold. So now that will definitely be multiplied by 45 rand in order for us to get to that 85,500. Very important to be able to calculate those estimated sales. We call them estimated sales. That means we're estimating to sell this number of units in order for us to incur this variable cost and to incur this fixed cost of 50,000 rands. So now the information provided, it is the estimated information. Then I will do some calculations based on that estimated information. Then we have the requirements, which is to calculate the contribution per unit. Now, contribution per unit, it is selling price minus variable cost. It is selling price minus variable cost. All the costs that are variable must be taken into account in order for you to get to the contribution per unit. Now remember, the variable cost, which in abbreviation is VC according to me, include all the costs that are variable. When I'm saying all the costs that are variable, I'm referring to production variable cost, which is direct material, your labor, and your variable overheads, plus non-production variable cost, which can be your selling and distribution that are variable, your marketing costs that are variable, your delivery costs that are variable. As long as cost is variable, it must be taken into account. Then after, we have a break-even point in units. So now this break-even point in units, it is the number of units that must be sold in order for the company to make no profit nor a loss, meaning in order for the business to be at the break-even point. Now, how do we calculate the break-even point? It is total fixed cost. And I want to highlight this total fixed cost because we might need to add different number of different fixed cost, the one that are production related and those that are not production related, as long they are fixed. Total fixed cost divided by contribution per unit. Remember, now you would have calculated the contribution above by saying selling price per unit minus all the variable costs per unit. So we take that contribution per unit, we divide it in our total fixed cost in order for us to get to the number of units that must be sold in order for the company to be at the break-even point, or in order for the company to make no profit or no loss. Then after number 3, we are required to calculate the break-even value. That means how much is the sales revenue that will be received in order for this company to be at the break-even point, meaning how much the sales revenue, how much are we going to actually receive as revenue from sales that will lead to that break-even units. Obviously, we have calculated the break-even units, meaning the units at the break-even point. Remember, every unit that we have calculated here that leads to the break-even point is sold at 45 Rand. So now our sales value at break-even, or break-even value, will be break-even point BEP times by selling price. That will give us the break-even value or sales value at the break-even point. Please go to your textbook because there is another alternative on how you can calculate your break-even value. It's not only limited to this information. It's either you can say total fixed cost divided by contribution ratio. You can say total fixed cost divided by contribution ratio, of which contribution ratio I will not talk about that one in this exercise, but take note of that also. Then after we go now to margin of safety. Margin of safety says that estimated sales, there's also a formula. It says estimated sales, and remember I said these sales are estimated sales, not actual sales. Estimated sales minus break-even point units or break-even point sales. It doesn't matter how you put it. It is sales units. Break-even point sales units, meaning the units that must be sold in order for the business to be at the break-even point, divide by estimated sales. Divide by estimated sales. Remember, our estimated sales, it is 1,900. So now we still need to know how much will be our units at the break-even point. Then now we go to the last part of the question. Last part of the question say that the number of units that one BAM must sell in order to make a profit of 240,000 is what we need to calculate. Now, there are times where the owner wants to get a specific profit or a specific return on the investment. Now, if you know how much return you want to get on the investment, then you can put a target in place before time or before the sales can take place, so that you know how much the target sales, so that you can reach at your required return on the investment or at your required profit. So now, so that if the sales exceed your target sales, then you'll know that that becomes a top-up or a bonus that can also be given to your staff for their excellent work or their excellent performance. Now, when that is the case, remember this is the number of units that must be sold. So this is not far away from calculating break-even point, but in this case, this break-even point has a required return or a required profit. That is the only difference. Now, in this case, what is the formula then? The formula says total fixed cost. It is total fixed cost plus profit or plus return on investment. Sometimes they say the owner wants to get a return on investment, which is called ROI, return on investment. So we say total fixed cost plus return on investment divided by contribution per unit. So the contribution per unit has not changed. It's the same contribution that we would have calculated in the beginning, which is selling price minus variable cost of 17 Rand. Definitely that will be 17 minus 45, then meaning our contribution would have been 28 Rand, which would have been used in the calculation of the break-even point units, which will also be used in the calculation of the number of units to be sold in order for one BAM, the owner or the investor, to get a profit of 250,000 Rands and enjoy it. Now, Let us then now respond to the questions. Now I was just analyzing the question, which was already responding to the questions at the same time. So now if you want, you can practice yourself and you listen to me after you are done practicing, because I've done the full analysis. Number one, we are required to calculate contribution. We know that contribution, it is selling price. It is selling price, and our selling price is 45 Rand. Then after we say less variable cost, and our variable cost was only one amount. We had variable cost of one amount, which was 17 Rand. Then after this will give us contribution per unit. Our contribution per unit, it is an amount of 28 Rand. Then after we go to number 2. So we do have our contribution. Let me explain something that is very crucial with regards to contribution. The question is, what is contribution? Now, a contribution is the portion of the selling price after variable costs have been covered that is used to cover fixed cost. Let me repeat that one. It is the portion of the selling price after variable costs have been taken into account that is used to cover fixed cost. What does that mean? It means we do have fixed cost in total. If you remember, our fixed costs were given to us as a total amount of 50,000 rands. This is our fixed cost. Now we made one sale. Let us say we're selling one unit, because this is selling price per unit. This is variable cost per unit. So in other words, we are assuming one unit is sold. Then now we say we have received 45 Rand. In this 45 Rand, we deduct variable cost, meaning we pay for the variable costs. Then when we pay for this variable cost, we are still left with a legal profit of 28 Rand. And we know that this is not a net profit, to be honest, because fixed costs were not taken into account. It's only selling price minus variable cost. So now the fact that fixed costs were not taken into account, it means the remainder of this amount, which is 28 Rand, must be used to cover fixed cost. So now the amount of the contribution is the amount that is used to cover fixed cost. That means, what does this mean? It means we are going to say fixed cost coverage, coverage, this is just my own term. It will be 50,000 rands. Then now in this case, we sold one product. We made a contribution, or there is a remainder of the contribution of 28 Rand. What are we going to do? We're going to say minus 28 Rand. Then we sell a second product. We say minus 28 Rand. Remember, the assumption is that the selling price remains the same and the variable costs also remain the same. They don't increase. So hence I deduct 28 Rand throughout. Then again minus 28 Rand for every product. Unit 1, a second product sold, third product sold, fourth product sold. We take that remainder after variable cost have been taken into account, and we deduct it from our fixed cost, because fixed costs were not yet covered here. It was only the variable cost. Now what does that mean? It means, remember, all these 28 Rand, they are what we call contribution. That means when fixed costs are equal to the contribution, then the company will be at the break-even point, because remember, variable costs are already covered. So the minute these 28 rands, all these 28 rand of every unit that you sell, the minute they are equal 50,000, that means the company has covered now all of its cost. So now if the company has covered all of its cost, that means the company is now at the break-even point, BEP, at the break-even point. So now that is why it is important to highlight the fact that when we calculate break-even point, we use the component fixed cost and the component contribution per unit. That is why we use these two, because these two are the ones that are going to lead us to getting to the break-even point, the number of units that must be sold in order for the business to be at the break-even point. So this is what the contribution simple means. Now we go to number 2. Number 2, we are required to calculate exactly the break-even point, which is the total fixed cost divided by contribution per unit. Now we have our break-even point, BEP, in units. Please write the full details, don't use abbreviation. It is total fixed cost, total fixed cost divided by contribution per unit. And we know that our contribution per unit is already 28 Rand, which we calculated in number 1. Total fixed cost, we only have 50,000 rands. Remember, you might have different fixed costs, then you just need to add all of them. Divide by 28 Rand. This will tell us how many units must be sold in order for this company run by Wambam Limited, or called Wambam Limited, to be at the break-even point. 50,000 rands divided by 28 rand. It is in decimal, that is not a transmesh at all. Let me just write it there, then write the whole number after. It is 1785.714257, which is equivalent to 1,786 units. That means when the company sells 1,786 units, it will be at the break-even point. That means when the total fixed cost is approximately equivalent to the contribution. So now 1,786. I was just verifying that now in my computer. Then what does that mean? It means if we say this is the number of units that will be evidence, or that will be at the point where fixed cost contribution. Let us verify that. How much is our contribution per unit? Our contribution per unit is 28 Rand. So now if you say 28 Rand times by the number of units at the break-even point, which is already on the screen, times by 28 Rand, this gives us 50,000 rands, just that bracket there, times by 28. This gives us 49,999 rand 99.99 cents. Obviously 50,000, you can see that. So now that means by taking your number of units at the break-even point, you multiply by the contribution, which is the amount that will be covering fixed cost. This should give you the total fixed cost, just to verify. Obviously, with the rounding off, it will be a slightly difference. Let us say 28 Rand now times by 1,786. We get how much? 50,008 Rand. You see that? So it's just the issue of rounding off. Otherwise, it should not bother you. Then now we go to number 3. Requirement number 3, we are required to calculate the break-even value, meaning how much revenue must be received at the break-even point. Remember, we are selling 1,786 units at how much? At a selling price of 50 Rand. So the break-even value will be the break-even units we calculated above, multiply that by the estimated selling price. So now it will be 1,786, multiply this by 45 Rand, meaning the break-even value will be 80,370. That means this is the income that we are going to receive as our sales revenue that will appear in our income statement, and at a selling price of 45 Rand with the units of 1,786. Now that is very clearly stated. Then now we go to the next second last requirement. So now in other words, number 3 is very easy and very simple. Number 3, we're calculating break-even point value, break-even point sales value, it is 45 rand times by 1,786. Then how much do we get? 45 rand times by 1,786. We have calculated that 80,370 already. So now this will be the amount that we are talking about. Then we go further now to the second last question as we approach the end of this lovely easy topic. Very lovely, very applied topic. When you run a business, make sure that you master this topic. You can do this in a spreadsheet and analyze all your cost, variable cost, fixed, and your contribution, so that you don't just see yourself not making a profit without not knowing. Next very lovely calculation or requirement is the margin of safety. What is margin of safety? Margin of safety, it is the safety position that such that even if sales decrease by less than the margin of safety, the company will still be in a safe position. But let us just answer the question and deal with the details of explaining. Then we are now in number 4. Margin of safety is where we are. It is margin of safety. Margin of safety. This is the safety margin. And let us just check if it's margin of safety ratio. Yes, margin of safety ratio, not in units. Now and again here, there are two formulas. It can be in units or in ratio as a percentage. As I said to you that it is estimated sales. Estimated sales minus break-even point units or sales units, that being in bracket. Also for accuracy in your calculator, divide by estimated sales. Remember, I told you that the sales that are estimated are 1,900. 1,900 is our estimated sales, which were at 45 rand, where we divided our estimated sales value of 85,500 by 45 rand in order for us to get to the estimated sales. So sometimes they can give to you that figure as is. So we have 1,900 as our estimated sales minus break-even point units, which is 1,786 that we just calculated there above. Then after we divide this by 1,900. Guys, the minute your estimated sales is not the same as your break-even, is less than your break-even sales, there is a likelihood of a problem there. Now, because this is a ratio, meaning a percentage, then we need to multiply this by 100. Then now we go on that same note doing the calculations now. Then we say 1,900 minus 1,786 equals divide by 1,900 equals times by 100. We get to 6%. We get to 6%. It's not 6% per annum or per what, it's just 6%. It does not go further than that. Now, what does this mean? That is very important. Now, this in simple terms, it means if our sales decrease by, let us say, 1%, like for instance, let us say our sales decrease by 1%, that means the company will still be making a profit. Sales decrease by 2%, company still is making profit. Sales decrease by 3%, company is still making a profit. Sales decreased by 4%, the company is still making a profit. Sales decreased by 5%, the company is still making a profit. Sales decreased by 6%, the company is at the break-even point now. So in other words, the margin of safety, it is the safety position at which sales can decrease by, but the company still be not making a loss. So now the minute sales decrease by 6.1%, then now the company begins to make a loss. So you get to know that, okay, if my sales decrease by this amount, I'm still safe, I'm still making profit. But when they increase by this percentage, then now I am definitely at a loss already. Then now this is the margin of safety as a percentage. We have the margin of safety in units, because remember, the percentage is not the actual number of units, but you can be required to calculate any one. And I want to bring you now to 4.1, which is my added information, which is another formula available there. The margin of safety units. The margin of safety units. Now, in other words, how many of these units, this 6% is how many units in simple terms? It is the estimated sales minus break-even point units. It is estimated sales. Estimated minus break-even point sales. Remember, our estimated sales is 1,900. So the 1,900 minus 1,786 is the one that will give us the number of these safety units. 1,900 minus 1,786. This is going to give us 114 units. So now the 114 units is the 6% in simple terms. You can verify that by yourself, do the testing of that 6%, which we have done already. There is the 6%. Now, that means if, let us say, our sales decrease by 10 units, we are still very safe. 20 units, very safe. 30 units, very safe. 100 units, still very safe. We are still not making loss. Remember what I'm saying, safe. When our sales decrease by 114 units, we are now sitting at the break-even point. The minute our sales decrease by 115 units, therefore now we are starting to make a loss. So the margin of safety, guys, is a very powerful if I can say, topic or a piece of information that one needs to apply. Either you're running your own business or you're running somebody's business. This is information of management accounting that is very crucial, so that you don't see the business going bankrupt without knowing where you went wrong, where you did not budget very well. So now that is number 4, just further explaining that one. Then now we go to the last supposedly question, which is question number 5. Question number 5, I did also explain this. It is very, very also a lovely one, where the owner knows how much profit he wants to make. So in other words, it says, I know how much I want to sell my product. I know how much variable cost in terms of estimate that I will incur, and I know my fixed cost that I am likely to incur. Remember, fixed cost in total remain constant. So now that I have an estimate of my cost, then now I can predict how much profit I want to get out of this product that I'm selling, or out of this business. So now that I've predicted the profit, then I need to know how many units must be sold now. I want to know the number of units that must be sold in order for me to get to my target profit, or to my target return on the investment. So this is another very powerful one from the investment perspective, or from an entrepreneur perspective, or from the business owner perspective. So now we are saying that we are calculating the number of units, which is units at a target profit. Unit at target profit is equal to total fixed cost of 50,000 rands plus required profit 250,000 rands. Remember the formula: total fixed cost divided by profit or required profit or return on investment. Divide this by contribution per unit, which is 28 rand that we calculated previously. Then after, let me just add the two. We have 250 plus 50,000 rands. This gives us 300,000 rands. Then after, we divide this by 28 rand. So now we say 300,000 rands divided by 28 rand. How much do we get? We get 10,714 0.257143, which can be rounded off to 10,714 or 15. I prefer to say 15 because we don't produce half a unit. It has to be a complete unit. So the rounding off when it comes to units then goes differently than the normal numbers where we deal with figures. Now that means if this owner wants to get a profit of 250,000 as it is stated as expected return on his investment or profit. So now the employees need to work very hard in advertising or selling the products up to 10,715 units. Therefore now the owner will get his target profit of 215,000 rands. Now guys, with that I've touched all the basics that were necessary. Go through your textbook, read these examples, the examples there in the textbook, the green book, which is the old version. Then you get the grasp of what I've said in terms of theory now. With that guys, you've been very awesome, you've been very wonderful. Thank you so much.